please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The clock is ticking, the union budget is upon us. This is the last full-fledged budget before the general elections next year. It's also the first budget post the introduction of the revolutionary goods and services tax. Over the next 30 minutes, we speak with two major foreign investors to find out what they are expecting from the finance minister on February 1st and indeed from the Indian economy in 2018. Good evening and thanks for joining us on this special pre-budget series. I'm Latha Venkatesh. Among the big questions that bedevil foreign investors today are: one, will the finance minister impose a long-term capital gains tax on equities? And two, will this budget respect fiscal prudence? Well, I'm sure there are lots more questions. So let's go straight away to our first guest on the show, Lucy MacDonald, Chief Investment Officer of Global Equities at Allianz Global Investors. Lucy has, of course, been in this position since 2001 when she joined Allianz, and before that, she was at Baring. So that's nearly 2 decades of watching global equities, emerging market equities, and watching India. Lucy, it's a pleasure having you with us. Well, first up, do you guys really look at the budget very closely? Is it a serious policy document that can make or break your attitude to Indian equities?
Well, what we're really looking at is the impact that it will have on earnings, because at the end of the day, it is earnings, liquidity and valuation which drive the various markets that we're looking at. So the impact of taxation on earnings is something that is going to be of importance to us.
Okay, so you must have picked up a lot of straws in the wind before the budget. What would you want to hear, say, on fiscal prudence, say, on corporate taxes?
Well, we want to see some, clearly prudence is something that we will favour, but we also want to see any impact where taxes can be looser, and that will benefit the tax, the earnings of the underlying companies. So that's really what we're focusing on.
The announcement that there would be larger than expected government borrowing this year has already pushed up yields. Of course, yields were headed higher also because of higher oil prices, higher commodity prices. Would you worry if interest rates were increased by the Reserve Bank, probably because of the deficit or probably for other reasons?
Well, we're seeing everywhere a shift upwards in long-term interest rates now, and the short-term we're beginning to see rising in the US, we're beginning to see it rising in the UK, and so it is beginning to be a bit of a trend, and we're watching it very carefully. Now, the valuation of earnings of companies versus bonds has given quite a good buffer for the relative valuation. So that has meant that bond markets can underperform and in fact fall, but still equity markets have support because of that earnings support. Now, as we get towards some of the higher levels of yields, and that buffer begins to be quite narrow. But as we see it at the moment, there is still an equity risk premium which is supporting equities over bonds.
Okay. Well, which brings me straight away to your earnings expectation. What are you expecting in the current season itself? The third quarter numbers for several consumer companies, for Reliance Industries, have all been above expectation. What is your earnings expectation for FY18 and more importantly for FY19?
Well, it looks to us as if the mid-teens to 19–20% is possible this year, which if achieved, will support the current valuation on the market. And as I said, the earnings momentum does seem to be now better supported in India relative to the rest of the world than it has been for the last few years. So that is encouraging, and it would be good to see that catching up with the strong sort of top-line economic growth.
Well, that was going to be my next question. How are you looking at Indian valuations now? The Sensex and the Nifty have had about a 30% gain in 2017, the mid-caps 40%, and the small caps over 50%. Are valuations at discomfort zone at all?
Well, valuations are very much mid-range at the moment in India, and that is certainly on a price to book. Probably the best place to look at the moment because of some of those issues with earnings over the last year that I mentioned. So it is neither a strong buy nor a strong sell, and there is enough upside there in valuation terms if the earnings come through to provide a decent return in the market.
What are the sectors that incrementally look attractive to you, given both valuations and earnings expectation?
Well, it's the more cyclical areas of the market look as if they've got more upward potential in valuation, and that is still the case elsewhere. Interestingly, so in our global portfolios, what we've been doing over the last few months is taking some profits out of some of the high momentum areas like technology, which has done extremely well, and that is also the case in India and in Asia more generally. So that's what we've been doing, and then investing those proceeds in some of the more cyclical areas, in some of the energy related, and also in financials, which should benefit from those rising interest rates that we mentioned earlier.
Actually, let me put India in the context of emerging markets. Where is it in the pecking order for you?
It is rising because of earnings momentum, and the relative earnings momentum improving certainly means that it's more attractive. The valuations are mid-range, and therefore that's not a barrier. And I think it's offering sort of idiosyncratic growth, so domestically generated as well as externally, and that's always interesting in the terms of a global portfolio.
Well, how do emerging markets stack up vis-a-vis developed markets for you, especially given that in the last few days we've seen US rates ticking up, 2.66 as I speak?
Well, the undervaluation of the emerging markets, which was clearer a year ago, is less the case now. So there's been some revaluation. However, the earnings momentum is still quite good, and there's decent yield which is available in the emerging markets too. So I think less attractive than a year ago in a relative sense, but still probably more attractive than average.
Okay, well, let me come to this growth issue. We had that piece from Mohammed El Arian asking if the global growth is now in a new paradigm, in a new normal, where growth may be much higher than it was in the last 10 years when it was in a new normal of slow growth. Would you say that equities have some more legs to run?
We think equities overall are still supported, but we do think we are towards the end of this very strong run, and valuations would suggest that, but also coming to the end of that big liquidity push, as I mentioned. So we still are positive, but we do think that the nominal returns are likely to be lower going forward than they've been in the last few years. Now, as far as growth is concerned, we think that growth is still likely to be held back in the mature world by the levels of debt. And the levels of debt have not come down, in fact they've gone up. And so that is a constraint on the growth rate that can be generated. Elsewhere, in emerging markets, the debt issue is not so widespread, outside China in particular. So it does look as if there is more potential for decent growth. So we are seeing decent growth, but it's not going to be at high levels, we think, in those areas which are still constrained by debt.
Lucy MacDonald, it was a pleasure listening to you. Thank you very much for joining us.